Ladies and gentlemen, the day has commenced. The first Fed cut in a long time, since December of 2024 to be more specific. Now, in this video, we're going to be going over basically a summary of what the Fed said today, what I'm taking away from this, and how to apply this as an investor in markets. In simpler terms, is this negative or positive, right? That's number one. What am I doing with this newfound information, and how does this change my medium to longer term view on this market? To me, it looks pretty straightforward and simple. Now, I am going to share with you a clip from CNBC. I was hoping Tom Lee actually, said something about the Fed, but he has not. It says here, markets could be looking at the Fed decision as a small policy mistake, says Jefferies David Zervos. He's one of the top analysts in the world. He's covered semiconductors, tech, NVIDIA for a very long time, has been very bullish on the space for a long time. And he always gives his take on the Fed, following the Fed. I actually don't agree with that take. Okay, I agree with a lot of what he says. Okay, but I don't agree that the markets are looking at this as a policy mistake, or at least I don't think that's going to be the takeaway from this Fed meeting. And I really think you need to hear this information. We're also going to be going over the economic data coming out tomorrow, because we will still get some economic data. And that's what's going to be important from this point on. The Fed makes it clear things can change. Even like from the last Fed meeting back in June, we were pricing in one cut or maybe no cuts this year. Now we just got a cut, and even the Fed is pricing in 2 more cuts this year. Okay. The area in which a lot of people, or some people like David Zervos, is going to say the markets might look at the Fed's, dot plot as a policy mistake, or at least a small one, is the dots for 2026. So essentially, we're expecting 3 cuts this year. We just got one. So 2 more cuts. And then only 1 cut in 2026. And then 1 cut in 2027. Okay. This is very important to understand. I think it's obvious that the Fed just doesn't know, right? The Fed is probably even less confident than you are in what inflation is going to do, what the economy is going to do, what the labor market's going to do. They have no idea. The Fed operates under a framework of, we don't want to be super wrong, okay? The Fed feels like they can confidently say that they can cut rates 2 more times this year without hurting their dual mandate. But they're saying, in simple terms, for 2026, the wide range of possible outcomes means they just don't know. Okay? Like, for an example, if the Fed came out and said they had to cut rates 3 or 4 times next year, okay, markets might like that a little bit. But then what if they had to walk that back and they only did do 1 cut? Then you're set up in a negative surprise environment throughout the entire year. I think we're actually very much set up in a positive surprise environment, because the odds, as Jerome Powell put it, when you look at the probabilities, there's probably going to be more than 1 cut next year. Okay? If we only got 1 cut next year, that is assuming the economy basically plateaus from here, just probably gets a little bit stronger from here as we get disinflation, as we get inflation that continues to fall. We're going to get more cuts depending on how the economy does and what inflation does. I view inflation as coming down, okay? I view inflation into the end of the year coming down, and in 2026, ultimately coming down as well. So really what I think markets are going to take away from the Fed is, boom, confirmation that the markets were right in implying cuts at every Fed meeting throughout the rest of this year, okay? September, October, and December. We were right. That is confirmation. That is what the Fed is telling us they plan to do, okay? But I think where a lot of Wall Street, or maybe, I don't want to say newbie investors, are going to look at the dots for 2026 and say, oh my gosh, yeah, that's 2 or 3 less cuts than we were expecting. And on face value, that sounds bad. But in all reality, if you connect the dots of what Powell said today, he basically said, we don't have any idea what is going to happen next year. I think they're looking at next year and put those dots down as like no matter what, we're going to cut rates one time next year. That the upside is of more cuts, not no cuts. Does that make sense? Okay. So I think over the coming days, this is actually a very positive event for stocks. Okay. It's a little messier on face value because, again, that 2026 projection, 2027 as well, you're only projecting one cut. But as time goes on, Fed's going to get more clarity. I talked about this before, but the Fed needs to be like babied, okay? The Fed doesn't want to make a mistake. The Fed's like, I didn't want to say that. I was going to say, the child that gets scolded all the time by their parents. They don't want to make a mistake. Oh my gosh, you can't do this. That's the Fed right now, okay? They don't want to make a mistake. They don't want to signal the wrong thing and be completely wrong, especially when the Fed is in so much spotlight from the current administration, in which they are, okay? But they have no clue. You probably have a better idea of what the economy and inflation and the labor market's going to look like next year than the Fed. They are operating under the same information as we are. So again, logically speaking, one cut is the absolute bare minimum next year in 2027. Whether we get more cuts than that has to do with how fast inflation falls and how the economy does. That, I think, is very positive, okay? What a lot of people are not going to mention as well is the dot plot itself was actually very positive, okay? Always remember this. No matter what is going on, like literally, back to basic principles here. No matter what is going on, stocks will do good or bad based on earnings, longer term, right? Other things can affect multiples and valuations, short term, good or bad, okay? But what matters most, how is the economy doing? How is the labor market doing? Okay, and recently, how is inflation? Well, again, the Fed in their dot plot expects stronger GDP than they were back in June, okay? So even though they're expecting or saying the labor market is weakened, they actually put in their dots that they expect unemployment to remain around these levels and trend lower over the next couple of years. Whether or not that happens, again, time will tell, but on face value of the dot plot, that's good. Because where we are right now, Fed's projecting higher GDP, lower unemployment, slightly higher inflation for next year, big whoop, but a series of rate cuts. So we have a solid start to the easing cycle with an economy the Fed believes will hold up or actually accelerate from here. It's good for earnings. Rates coming down, good for earnings. I've talked about this so many times on the channel, okay? Don't get lost in the sauce here. But not all rate cuts are equal, okay? If we were to get a 1% rate cut today, markets would be down like 4% right now on the indexes, 4 or 5%. Why? Not because a quadruple rate cut is bad, but because of why the Fed is doing that would be very negative implications. Think about this. We have not gotten a rate cut since December of 2024. Look at the markets today. Okay? Look at your portfolio today. Okay? Portfolio today, down 1.36%. Not a, whatever kind of day. Portfolio year to date up 186.34% in this one. Other ones are up similar amounts. Okay? You don't need rate cuts. It's the reason why the Fed is cutting rates that is more important. And it looks like today, the reason why the Fed is cutting rates is not doom and gloomy. Okay? That's where I think you get the confirmation aspect that should be looked at as a positive. Now, we are in September. People are nervous. They're jittery. Okay? But beyond that, if you're actually understanding the words I'm saying in this video, markets are going to come to the conclusion of the Fed doesn't know what's going to happen in 2026. They are essentially data dependent again. But they confirmed they're going to cut rates 3 times this year. Once today, 2 more times. That was in line with markets' expectations. Now, again, what happens in the very short term for stocks, because we are in the month of September, is anyone's best guess. Okay. Tesla was up 1% today. Indexes closed in the green, pretty much across the board. IWM up 0.25%. NASDAQ down 0.2%, up 0.10% in after hours. S&P down 0.12%, up 0.06% in after hours. Now, when you actually look at this from a technical basis, it looks really good, okay? You got a hammer candlestick. Anytime you see a hammer candlestick pattern, stocks tend to go up on that. Why? Because that means you started high, okay? You started the day high, you fell a lot, and then you recovered to close near the high of the day. You closed with upwards momentum. That tends to lead to a continuation over, coming days. It's one of the best confirmation signals I've found in recent times to indicate you should be long the markets. It's not a recommendation. It's not financial advice. Could you lose money here? Sure, it's going to be volatile. But give it a day. Give it 2 days. And I think Wall Street is going to say, yeah, this was a good Fed meeting. I'm just early in telling you this. I'm telling you this before everyone else realizes it. Take a listen to what David Zervos said about this Fed meeting and how the markets might be looking at this as a small policy mistake. Again, I disagree with that. I think markets just want a bunch of clarity, and the Fed, they're not willing to stick their neck out and give you any kind of certainty. They're basically saying for next year, anything is on the table, but at minimum, you're going to get 1 cut. So the probability likely favors more than 1 cut. We're just going to have to wait and see. In this very short term, though, the Fed being aligned with markets is great news. If the Fed would have came out and said only 1 cut this year, 1 cut next year, yeah, this would be a different video. Okay. But it seems like the markets become very certain on what the next couple of months are going to look like. And then once you start looking out the next year and the year after that, it's like, who knows, right? So take a listen to this, compare and contrast to what I've said so far in this video, and try to understand this narrative that I'm sharing with you.
Point cut was the vote of 11 of the 12 voters. The lone dissenter was brand new Fed Governor Steve Myron. He wanted a 0.5 point. That's not as much as our next guest. Joining me now is David Zervos. He's chief market strategist at Jefferies and a CNBC contributor. He's been saying they should have cut 75 basis points at today's meeting. Hasn't met with the Trump administration about the Fed chair nomination. David, good to see you. So I'm trying to figure out how far off from the range are you here? 75 looks like a big number, but how many more cuts do you think are needed for the rest of the year after that?
Well, John, first of all, let me say, I talk about what I think should happen and what I think will happen. And I certainly was in the camp that they would only go 25. I didn't think this committee would come to it, but I've added some spice to what I usually say on this program and others with some of your other hosts and other hours, offering what I think should happen just because of this contention storyline for me. So I wasn't surprised by much of what Powell said. I thought he was actually kind of nervous about the labor market, a little more dovish than I thought. And I think where the market turned on him was the 50 discussion. Why wasn't 50 even discussed in any meaningful way? And I think the market expected that to be the case, and it just wasn't the case. And that's why you got the dollar ripping back up and the yields coming back up as well. The market is looking at this like maybe a small policy mistake, that we should be lower, we should be less restrictive. They're taking some undue risks on the employment side. And they have a lot going for them on the inflation side if that labor market forecast is weaker in the future. So I think the market reacted kind of right to that, and I think the Fed did sort of what you expected them to do, and I don't think there was much new here.
David,
as for
you talk about the market's
thoughts,
reaction. Which reaction are you talking about? Because the market seemed to do a couple
to the discussion of 50.
Right, but both the stock markets, we just heard from several of our journalists here at CNBC, both stocks and bonds made some moves in a couple different directions after the announcement and then the commentary. And then, the S&P closed just off of flat.
Yeah, I mean, look, at the end of the day, these are pretty unchanged markets, as Rick was saying in the beginning, from where we started the day. But I think the market was excited about a dovish Fed. They thought Jay sounded dovish. The statement talked about labor market weakness. They focused on labor market weakness. The balance of risks had moved. Everybody got excited. You take the 10-year to 398. You take the dollar in, euro dollar up to 119 and change. And then you listen to Jay. And he says, we didn't even talk about 50. And the market turns it around and takes it back to unchanged. That's basically the story of the afternoon. Completely understand why the market did it. Kind of completely understand why they did the 25. I'm a little not unhappy, but I find the idea that we're not even discussing 50 to be a little bit of a silly idea. And I think the market reacted accordingly to that. When Jay was asked as well, I think Nick Timmerose asked him about, would you consider the 50s and how do you think about 50s? He might made some argument that those are only in really special times and really unusual times, like during COVID or like during major crises of sorts, which doesn't really bode well for what he did back in September just before the election. So I think it's a little bit suspect why the 50 wasn't even discussed, and I think the market reacted to that.
Well, when we see what the different voting members of the Fed are expecting for the rest of the year, and I guess maybe more than just that, where do you fall on how many cuts? Because maybe you're saying you just think that a bigger cut is necessary up front, but you're more in line with the rest of the Fed governors on where we end up?
I guess the way I think about it, John, is most of the committee wants to get there. They seem to want to get there in the next 12 weeks. Why not get there sooner? Risk manage a little bit more to this unbelievable change in the labor market outlook after these two sets of revisions that we had, both the revisions recently and then the 2024 revisions that were seismic, really. Okay. So the whole model is basically thrown out. The immigration story is now being replaced with a productivity story. I think you go take out a bigger insurance policy and say, look, we're going to wait and see. But this was a very significant change in the labor market outlook. And by the way, Jay sounded like he thought it was a very significant change in the labor market outlook. So I don't really think you had a storyline that didn't warrant at least an active discussion of 50. So I think that's why the market was modestly disappointed. I would be happy to see 75 lower and then we just go meeting to meeting and watch it and see what the data says.
So yeah, I pretty much agree with everything he says, besides the point that he thinks the markets are looking at this as a small policy error. I could see how stocks maybe short-term reacted like it was maybe a little bit of a policy error, but usually when you say the Fed made a policy error, it implies that, it's going to be a long-lasting event, right? When like the Fed failed to react to inflation, that was a policy error. It was pretty dramatic, right? It's not a policy error in that sense of the markets are going to hold on to it as, oh my gosh, we should have done something larger, right? That's not the sense of what I'm getting from the market. So I do agree with a lot of pretty much everything he said, though. Again, I'm not super shocked where the markets are and what happened, how we did fall and then go back up. There were certain aspects of Powell's commentary that, again, as Zervo said, sounded pretty dovish or nervous on the labor market. I think that's probably the highlight of what got, stocks actually selling off. But then markets realized, oh wait, that means more cuts, right? So there's a little bit of a give and take, but I do think it confirms that we are still well intact for an end of the year rally. And if anything, labor market's going to be, according to the Fed's dots, better than expected and strengthen. And the economy is going to be better than expected, which if you take that off of face value, that sounds really good mixed with 2 more Fed cuts this year. And then 2026, basically a toss-up. So I think for Tesla, even look at Tesla today, up 1%. The stock closed above $425 per share. Okay, which is a very important level. It's important that we close above 420 because that really sets us into a range to potentially rally to new highs. Now, keep in mind, I was talking to members in the trading community, link down below in the description of this video if you want to come join that, about the seasonals in markets from this point on. Today was the start of the worst 10 days for the markets. From September 17th through the end of September, these 10 trading days we have are the worst 10 trading days for any year and any time of the year. Okay, so just again, keep that in mind. Doesn't mean we're going to sell off, but it's not really something that's working for you either. It is kind of working against you. But I do think Tesla stock here has a lot of momentum and will likely continue to move higher. The Fed, I don't view it as a catalyst to crash stocks, right? That's not what I got out of today. So hit the like button, subscribe to the channel if you have not done so already. Ladies and gentlemen, have a great rest of your day, and I will see you in the next one.